Welcome to the Tokenomics DAO podcast, where we explore everything tokenomics related, ranging from deep dives on the tokenomics of the newest protocol to demystifying the nuance of building a successful token ecosystem. Our goal is to bring awareness to the importance of tokenomics and the crucial role it plays in defining the success of a protocol, helping make tokenomics relevant for everyone, builders and investors alike. I'm your host, Flo, joined by my co-hosts, Jason and or Lovis. Welcome to the podcast. Today, without Jason, we wanted to talk about, wanted to do an intro to tokenomics. Kind of comes from many people have had the interest in the field, and they all said like, yeah, we're super interested, exciting what you're doing, but we don't understand really what this is all about. So I don't know, are we like 18 episodes in or something?
Yep, something like that.
Yeah. So might be a good time to actually define, or maybe not define, but talk about or give an intro to what this actually all is, and maybe pick a few of these people up that have gotten lost along the way. Yeah. So I guess we wanted to do that intro to tokenomics, or basics of tokenomics. I don't know, something like that. Anyway, so maybe let's start with what it is, right? It's like you can pretty easily spot that it's a mix of token and economics. So I guess those two things brought together, I guess the economics of tokens.
Yeah.
And like economics also like concerns mainly supply and demand, but more things than that. I guess this tokens are similar, right? We have kind of the mechanisms of different blockchain protocols or applications that are on top of blockchains. And with these economics, we try to define how they, I guess, interact or work, and what the role of the token plays in that whole thing, right?
Yeah.
And
I always think with I think with economics in general, it's always very important to remember that it is definitely studied like a science, but it's a lot about behavior, studying behavior of people, and so it's not as hard of a science as physics or math, where you're like uncovering, laws of the universe in a way in physics. And you're just finding tools to describe them. Like in behavioral sciences, it's very much about you're trying to understand why people do stuff, and you're trying to push them or influence them to go one way or the other, which is maybe more favorable for the organization or for the country, the state, whatever, than the other thing. But I want to say it's an art as much as it is a science, right? Because this is very difficult to nail down in formulas. And so
yeah, I think
and so similarly in tokenomics, right? We try to use tokens to create outcomes, favorable outcomes for everybody, but in some projects it works well, and some it doesn't. and we study that, and we try to increase the odds.
Yeah. I think that's good. Yeah. And I mean, throughout this podcast, we should also make sure that we go through the terminology, because I often think we don't do that. So maybe for once in this episode, we can do that. Maybe talk about, briefly explain certain things like staking or a smart contract. I don't know if we want to go that deep, but yeah, I think it's a lot of that. So to maybe start with an example of what tokenomics would be that you might look at a blockchain like Bitcoin, and you would describe how the Bitcoin token is designed, right? And the Bitcoin token is super simple in the way they've done it. It has a limited supply, like only 21 million will ever be mined. Then there's certain rules on how new Bitcoins come into circulation, right? That goes via mining. So somebody has to expend energy and solve some math problems with that, with a computer. And then we'll hopefully be rewarded some of these Bitcoins. And what these miners do when they've solved that problem, they would, hash certain transactions that members on the network have done, and by that adding value to the network, right? So they add value by hashing a bunch of transactions that have happened. So I send money to Lovis, Lovis might send some to Jason, and all of that we're going to store on the blockchain, and the miners, by securing that, they get rewarded for it with these tokens. And then they have this interesting mechanism, which is called the Bitcoin halving, where every 4 years, this supply that is paid out for the mining of one block is halved, right? So it started with 50, and then 4 years later, it went to 25, 12 and a half. You get the idea. And now we're at 6.25 or something like that.
Yeah,
and
it's paid for every block, right? For every successfully mined block.
Yeah.
So the block comes.
Yeah. So every 10 minutes.
But every 10 minutes.
Yeah. So actually, like for Bitcoin, it's pretty much is a formula, right? And that's something that's interesting when you compare it to like normal economics, right? Because with tokens, you have this blockchain, smart contract, consensus mechanism where people agree on something. And in the case of Bitcoin, they agreed on exactly this supply and distribution mechanism. They all say, well, every 10 minutes, we're going to mine a block, and a block will contain a certain number of transactions, and whoever mines that block will get the current amount of Bitcoin that is paid out. And that will decrease over time. Every 4 years it will have, until it reaches, in the year 2140 or something, it reached this maximum of 21 million. So that's actually hard coded, and everybody knows that it's going to be that. And if you participate in the network, you agree that this is the way that it is, right? And that kind of is what makes Bitcoin so interesting, that there is not some central authority that could just decide to create a little bit more of it, and can just like keep it that way, right? It just stays that way. So yeah, that's kind of, I guess, like a really basic example of how you would describe the tokenomics of a protocol. And then there's like things in between to determine like how many of these tokens are currently in circulation and how many will be made available in the future. And that's something we can go into later on. But yeah, I think that's at a really basic level is what this is about, right?
Yeah, so maybe we can use this example really quick and explain some terminology. So we have supply, right? Total supply, circulating supply. What other supplies do we have?
Well, yeah, I guess there's like this.
The terms that are often used interchangeable, but they actually have slightly different meanings. So maybe we can just poke into that really quick. So the total supply of all Bitcoins there will ever be is 21 million, right?
Yeah.
The circulating supply, yeah, correct me if I'm wrong. The circulating supply is all the Bitcoins that are currently held in, let's say, active wallets, right? So
maybe
that means
just say like they have been mined, the ones that have been mined.
That's true, they have been mined. However, then there's also some that have been lost, right? That somebody forgot their password. Yeah. But would they still be considered circulating supply?
Yeah, I think so, yeah. Because we don't know for sure. Maybe somebody's going to find the password. So unless we know for certain that it's currently not circulating because there may be in other blockchains locked in a smart contract and only released in a year or two, then they don't count. They will count towards the circulating supply. So with Bitcoin, I think that's like 19 million. And that shows us that actually the large majority of the supply is already out there in circulation, right? And so 2 million is just left, and that will be mined in the next 100 years or something.
Yeah.
120, yeah.
And then there's a difference. So there's this other term, right? Fully diluted market cap, or like market cap, right? Those are also two different things. So the market capitalization is circulating supply times token price, right? So then you get it.
Yeah, that's like normal corporations, right? So if you look
Yeah.
at Apple, you would take the current share price
Mhm.
and multiply that by all the shares that Apple has out in the market, right? All the shares outstanding, and that would be their market cap.
Right. And then there's a slightly different metric that's the fully diluted market cap. So in case of Bitcoin, it would be price of token, but now times the 21 million. So all the tokens there will ever be, correct?
Yes, yeah. And that's something I don't think this really exists with like traditional corporations, because even though a lot of them create new shares, they don't do that algorithmically. And in the crypto space, many do that, right? So with Ethereum, they have this certain inflation of 1 to 2% every year, and other blockchains have that as well. And yeah, Bitcoin also releases a certain amount of tokens through this mining every year. So then,
and some other projects, like, even if they're not, so there's another term, Ethereum and Bitcoin are L1 protocols, right? They're layer ones. So that when we say L1, that means they're the base layer that other people use to build on or transact on. But smaller protocols or even DAOs can also keep, like, they can mint token and they can put some of it kind of in cold storage, so it's not really circulating. It has yet to be released to the market. But then when you look at these rates at which they release them, you always want to keep in mind these market cap and fully diluted market cap comparison, because if the release of the token is very quickly, then that means a lot of buyers have to come in to buy it up. Otherwise, the price of the token in nominal terms and dollar terms would most likely go down. So when you then see, okay, this, for example, this project is growing at, let's say, 20% per year. That means, you know, they're creating a lot of value. They're having tons of customers or whatever it is that they're selling or buying or whatever. Growing at 20% per year. But if they and you look at the tokenomics and they are planning to release way more than 20% of new tokens into the market, then that might be an indicator that that could have a negative repercussion for the price in dollar terms. Now, whether or not the dollar price of the token matters is a completely different story. This is just one thing to look at when you do analysis.
Yeah. So it's like with Bitcoin, you can see that, right? So it's currently, I hope I got the numbers right, the market cap is like some 379 million and billion, probably. It's billion. 379 billion. And that's with the market cap, with the circulating supply of 19 million tokens times the current price. We look, what is that? 19,000, right? So if you multiply these two, you get to 379 billion. And then the fully diluted valuation means that at the time when Bitcoin will have released all of its tokens, so the supply will be 21 million in circulation. If it had, if we were still trading at a price of 19,000, then the fully diluted valuation would be 417 billion. So that's like a small increase, or like a comparatively not so high increase. But what you'll see is that there's plenty of tokens out there that have a large difference between that. And that means that they have to kind of like grow, because through some mechanism, they'll be introducing a lot of tokens into the market in the coming years. And those tokens is supply introduced, right? So there's new tokens coming out of the market and someone needs to buy them, or else we'll have too much supply and that will drive the price down, right? So then if you're evaluating a project, you'll have to look at, is this demand for these tokens coming from somewhere? From what would it come? And that's really what we think, at least, tokenomics is, to a degree, right? Evaluating where that demand would come from. And you can see that from two different perspectives, right? There could be investors looking at that, but there could also be builders who currently build their own token, and they want to know how much they would have to grow their business. Like whatever they do, maybe they have like a a media publishing channel. Maybe they have a nice podcast, whatever they might have, but they would have to grow their users, their paying users, their revenue, all of that stuff to fit into that, into these new tokens that they're creating, so that people actually go and buy those tokens. And they won't have too many of them on the market to, yeah, crash the price perhaps because of an oversupply.
Yeah, I mean,
Yeah.
analyzing demand is probably one of the most challenging aspects of this, right? Because I mean, the supply of the token can be usually pretty analytical about. You can, use formulas to release them, or certain actions trigger a certain amount of release. But simulating demand or thinking that through, who would want to buy it and at what price point, that is very challenging. And in fact, if you can come up with a definitive demand model, then you'll be a Warren Buffett type investor. Like, you'll do very well.
Oh, even better. I think that will be that's the holy grail, if you can figure out how to predict demand.
Yeah, and
I
so
mean, yeah.
This goes back to my comment in the beginning. It's a lot about behaviors, right? So demand is very behavior driven. It's very incentive driven, and there can be a lot of hype, and so everybody buys it, and then the next day the hype is over, and then nobody wants it anymore, and you're like, whoa, what happened? You didn't really have any sustainable demand for your token, but you sure had maybe some dank memes.
Yeah. So I think, like, if you look at shares, right? Shares of a corporation, you buy a piece of ownership in a business. Like, you buy a piece of Amazon if you buy a share. And that doesn't really give you anything other than telling you that you own that business, right? You own a piece of that business. And shares in itself, you can't do a lot with it. You could just hold them, you can sell them, and they maybe pay a dividend, and corporations can buy them back. So those are kind of like the features that a business would have with this share mechanism, with this stock mechanism. But with tokens, there's a lot more you can do. And that's why we even think about attempting to predict demand, right? Because, like, it'd be hard to predict the demand for Amazon stocks. It'd be very much linked to how the business performs, like how much revenue it generates, how much profit it generates, how it expands, what their vision is, what their competitive advantage, and I don't know, lots of other things you need to look into.
Product lineup, all things.
Yeah. But with tokens, there's this other thing that comes into place. And maybe let's talk about these smart contracts for just a little bit, right? So a smart contract would be a piece of code that, similar to these transactions that we've talked about on the Bitcoin blockchain, right? They would be on the Ethereum blockchain, or on another smart contract blockchain. But there you could code some logic, right? You could code in some logic that would say, if you send funds to this particular address, then it will always do this. It will always, like, let's say Jason would send money to this particular wallet. It would always send half of it to Lovis and half of it to myself. So you could code that logic into the blockchain, and call it a smart contract. So then we could all kind of trust that piece of code, because it is backed by this consensus of all the different nodes that back this network. So if I send a transaction there, I'll know it always will do that. And if you want to change that code, it will get a new address. So you'll have to send it somewhere else. And with that programming logic, that makes this whole thing really interesting, I guess, because then now you can program mechanisms into the tokens. And that's what really makes them different to shares, right? So with shares, again, you can only do this like basic things, but with tokens, you could have something where I think Thorchain does it. Thorchain is this decentralized cross-chain exchange, right? So you go there and you can swap Bitcoin for Ethereum. And they've built this piece of software, and they have their own token called Rune. And whenever somebody deposits collateral for this exchange, so you put some money into something, then that needs to be backed by a certain amount of Rune tokens. right? So if I put in $10 worth of Bitcoin, I need to also deposit a certain amount. Maybe it's also 10, maybe it's $20. I forgot. I'll link the article down below so you can read it up. But there's like, let's say it's 20. So you have to put in $20 worth of Rune to back that. And that is programmed into such a smart contract, saying that this is the way this will behave. And this, of course, makes it, I won't say it makes it predictable, but it makes it like a little bit easier to get a feeling for how demand for the token would behave if we know how many tokens are locked up in this exchange. And this is, yeah, there's like all sorts of different examples where people have created these smart contracts that do certain things, right? So there's communities out there where I think Friends with Benefits, where they have this model. It's a gated community, right? So you can only join their Discord and discuss stuff if you own 50 tokens. I don't know how many it is, but like you own 50 tokens. And then I think what they do every year, they increase that amount of tokens, right? So you will, if you want to stay part of the community, then the next year you will have to own 70 tokens. So that will slowly, if the community stays the same size, it will increase the amount of tokens that are locked up by people to be part of the community every year. And I think that's like an interesting mechanism that in that way doesn't necessarily exist in the shares world. And that's what makes, to me, like tokenomics interesting, or more interesting, because you also look into these different mechanisms that exist, right?
Well, there's so many different applications, right? I mean, there's almost an infinite possibility. Like we've only probably seen some of the early applications of tokens. And I think you had an interesting conversation with Pantera Capital, right? And they said, what did they say again? I thought it was a pretty cool quote about technology.
Yeah, I think they said something along the lines of, in the beginning they thought tokens would just be like this copy and paste model where everything would do the same model like with shares. But then they figured that, it's more like innovates the same way or as quickly as the protocols themselves innovate, right? So people come up with all sorts of, because of these programmability, because of these smart contracts, they come up with all sorts of mechanisms that you build into what your token does and how it behaves, much more sophisticated than what you do with shares.
So that makes it definitely very fascinating to study, and to also not just study, but help influence and help build the cool next thing, I guess. Let's see. So, we were just talking about Thorchain and Rune.
Maybe let's go through like we talked about the supply, but I think we missed a few pieces of that supply. So on the supply side, we talked about, how much will be supplied, how much is circulating, the market cap, the fully diluted market cap, these different parameters on how to evaluate tokens quantitatively, right? So you can start by doing that. And it's really easy. You can go to CoinGecko.com and you just search for a token. And if you look at Bitcoin, you'll see right up the top, it shows the market cap, the fully diluted, they call it fully diluted valuation. I think fully diluted market cap is actually a much better term, because it just makes sure that everybody really gets that it's the fully diluted market cap. And then there's like circulating supply, total supply, max supply. So it's an easy, quick thing you can look at and find out, and just go to one of these websites and check that out. And then there's also a bit more. There's inflation, right? So it's kind of like, to me, it always is this, how many new tokens come into existence, or how many new tokens does the protocol create every year? Right? So Ethereum creates new tokens every year. They have like a schedule for that. It's also programmed how much it's going to be, and you can look that up. And so, yeah, they have something for that. And then there's emission. So inflation will be familiar because you know it from the real economy, right? So if the central banks, if they create more dollars, euros, whatever, there'll be more in circulation and inflating the supply. And so then there's also something that we call these emissions. So basically, there's been tokens that have been created that might have been locked up. So they're not really in circulation, but they count towards this total supply, right? So they're adding to this circulating supply. Could be emissions. And often when a token launches, people would, and that's nothing specific to tokens, that's also something that corporations do when they pay out employees or hand out tokens. They add these like vesting schedules. And vesting means they give you some tokens, but they say, here are the tokens, but you won't have access to them for the next year. That will be called, they're going to be locked for a year. And then after that, they will gradually unlock. Every year, you'll get 30% of them for the next 3 years or something. And those would be then the emissions. So then they would slowly unlock and be introduced to the market gently so that you don't crash it with too much supply, and that the business actually has the chance to create demand for them, right?
Yeah, and in the case of employees, the vesting has another purpose. To keep you engaged, right? They want to reward you with tokens, but they want you to earn them over time, right? And then there's another small concept that fits in the beginning. So you said, say the employee gets their allotment of tokens, and it's set in the vesting schedule when they start unlocking. And this initial period where you don't get any, where none are unlocked, is called the cliff. So there's a vesting cliff, and then after that, you get, that's why the graph goes up. That's why it's a cliff. Then you start vesting tokens, and then usually, so when a corporation, if you work for a startup, they have a similar concept with stock options, and then typically after the first year is over, after that your options vest monthly, but with tokens, it could be anything. It could be by the minute, could be by the month, could be by the year. Like, it doesn't, it can be set flexibly.
Yeah. So I was like, whenever I get into such a new topic and you just get confused by all these namings, and then every second person calls it differently, right? So some people might call it like, I don't know, they might call the emissions differently. They might call it inflation. Some might call it inflation. And then some people, they don't call it cliffs and vesting. They call it the locked period and the unlocked period. So that can often be very confusing, but in most cases, that's really what they mean, the same thing at the end of the day, if you figure out what it actually is. So it's this, like, how do the tokens get out into circulation over time? And so then, I guess there's one more thing that's important, and that's the burn. So similar to, I guess, like with shares, the similar mechanism would be almost a buyback, right? So if corporations buy back shares, they're not really burned, but they don't count towards the shares outstanding, right? So they're not counted in any of these metrics like earnings per share, things like that, right? So in this case here, though, it's like they really are removed completely out of circulation, and they can't be retrieved again. Whereas I think a corporation could at any point decide to issue new shares again, right? But here it's really like what they do, they pick an address in their network that does not have, where nobody knows the private key to, or generate one. And then, the tokens get sent there. So they sit there, but nobody can sign transactions to get them out there again. And that's just kind of, they're taken out of this circulation and can be burned. So this can be a mechanism to reduce supply. So a protocol could maybe do this automatically. And that's what Ethereum did a while ago, like last year, this time, I think it was. where they announced their implementation pack. EIP is what it's called, 1559. And in that, they introduced that with every transaction that they do, they're going to burn a certain number of tokens. And yeah, there's a nice website. We showed that in one of the earlier podcasts called, I think, Watch It Burn or something, where you can see how many tokens are burned and sent to this like dead wallet, taken out of circulation, basically reducing the supply.
And then, but so
Yeah, so that's something. Yeah.
right. So the opposite of burning is minting, right? So
Oh yes, yeah.
often there's a mechanism that creates tokens newly, and then that's called minting. Just like how the U.S. Treasury mints silver dollars. They put the metal on the thing and they run it over with the
coins.
They create coins, right? That's where the name comes from.
Yeah, the places where they do that is actually called the mint.
The mint, yeah, that's right.
Yeah, we have like a mint in Perth or in Canberra or I don't know where. Yeah. To create coins.
Yeah, so if inflation, emissions, burn, and minting, and then as to why you would want to burn or mint, I mean there's many reasons, right? Many different mechanisms, and today is less about that and more about just, I think, explaining the terminology.
It'd be like general monetary policy. It depends. Like if your token price goes down and you don't want it to go down because you see like your demand is not quite there where you wanted it to be, you might want to take some tokens out of supply to counter inflation. So all that stuff that central banks are doing, maybe, protocols, of course, can do as well, and can get involved in, right? So that's why they would want to do that stuff, really, in a nutshell, right? Without getting into it, like you said.
Political reasons. Yeah, and then important point, right? So the nice thing with token ecosystems, usually these things are very transparent because they happen on chain. So they're there and verifiable for everybody. And that is a nice segue to the next piece, which is distribution. Distribution at a base level basically just means who received how many tokens and maybe at what time, right? And this is many protocols and many projects do a really good job explaining that and make it very transparent, and some could maybe do a little bit better. But typically you can look at the documentation and study that, for a given protocol, and look at the token distribution, and you could find out, okay, the team received this many, I don't know, maybe there's another category for founders or investors, or all these different, or community, treasury, like there might be any number of different categories, but you can then find out exactly who holds how many tokens. And then something that we explained earlier, like the vesting or lockup period, might also be explained as part of this distribution plan, just so that people can have an idea not only who owns it, but also when can they trade them, when do they become part of circulation.
Yeah. So that's often like you find a pie chart. Misari often has that kind of information, or their own documentation. If there's like a half good protocol, they'll have their distribution. And by the way, it's also often called allocation, I think. And so yeah, they have kind of that distribution allocation scheme in a pie chart somewhere in their documentation. And then there's like different ways to do that even, right? So that's also an aspect of like tokenomics. Do you want to give it all to your investors, keep it for the team, and only give very few to the open market, right? So that it can be traded. Or do you want to maybe do something where you like airdrop all tokens to maybe past users of your application or protocol, right? So that's also something that have been explored. And for Bitcoin's case, it was just like whoever got aware of Bitcoin back then in 2008, 2009. Anyway, so whoever got aware of that and got a computer and started mining, yeah, they got rewarded Bitcoins, right? So it's like everybody's fair game. You just had to know about it, had to be able to set it up, and then you were theoretically able to get Bitcoins.
Yep.
Yeah, so that's also different. I think also like from an investors and builders perspective, this is something to be really careful about and look into, to find out, think through. Like, what do you want to do? Do you want to like make a lot of money fast, or do you want to build something maybe sustainable, and distribute your tokens wide to a lot of people? Yeah. And then I guess there's also like the prices. And that's the same with shares, right? Like pre-IPO, anybody can make a deal with a corporation. I mean, not we, but any institutional investor can go in and get some cheap shares before they're offered on the market. And that's of course the same thing here, right? So prior to token launch, often VCs and investors, they'll get in at, yeah, much lower evaluations of what the token is launched at, right? So then you can have like, they might have bought tokens for 50 cents per token, and then when the token launches, it launches at $1.50. So then they already have 3x by the time the token launches. And if they don't have a vesting, anything that prevents them from selling, they often will start taking profits quickly and sell out. So this has happened in a lot of protocols where like Kobe had some nice pieces on that, where he went through a couple of protocols where that has occurred, right? Where investors that have gotten in early had then like continuously started to sell because they had failed to set up proper vesting schedule that prevented them from selling. Right.
Yeah, and like then you often see price charts that blip up and then they bleed and bleed and bleed and bleed for months. Because and you're like, who's still selling? The price is already garbage, but
Yeah.
it's because so many people get in so early at such a low cost. They're still selling at a profit, right? Because their cost basis was just so much lower.
Yeah, so that's also something really to keep in mind when you look at these tokens, right? Try to find out. Like some will publish it, some won't. But yeah, I think it's good to consider that. For sure, yeah.
So that's really good discussion on distribution. Do we want to also, I guess, jump back up a little bit more, right? Because we had touched on Bitcoin, Ethereum. You have Uniswap on there as an example, because I think it'll help us dive into some other concepts that we also wanted to discuss.
Yeah, maybe we can, this whole idea of that not only Bitcoin and Ethereum can have tokens, and I of course, like many of you will know that, but yeah, there's also applications that can be built with smart contracts on top of a layer one blockchain like Ethereum, right? So Ethereum provides this base layer, but then somebody can go and create an application on top and even create a token for that application that is like sitting on that layer one Ethereum blockchain. And one of these applications is Uniswap. And so it's a really simple concept. They allow people to trade tokens. So you can only Ethereum tokens in this case. So if you wanted to trade tokens across blockchains, that's where Thorchain comes in, but that's a lot more complicated in how it works. But Uniswap is this super simple thing. You could take let's say Ethereum, the Ethereum token, and you could trade that for USDC, which is like a US dollar pegged stablecoin, and you could swap them. So let's say I wanted to turn my ETH into stablecoins. I could go to Uniswap and I can do that pretty easily, right? And then they have some mechanisms in the background that take care of that, involving liquidity pools and fees that are paid towards the protocol. And then yeah, their own token is then that they've created, the Uni token, that is then used to, I think, for governance mainly. Right. So they, the owners of that, or the holders of that token, they can decide how that treasury accumulates over usage fees, right? So somebody who swaps tokens will have to pay a little bit into their treasury. And then the token holders of these Uni tokens, they can then decide on what to do with that, with these tokens. Yeah, I guess that's kind of what this is, right? So it's not a layer one. It's also not a layer two, but it's like an application that sits on top of layer one. It's a smart contract.
It's probably a cluster of smart contracts, huh? But the
Oh yeah.
But so Uniswap is particularly useful because it has created deep pools of liquidity, right, for any number, not any number, but for a lot of the Ethereum tokens. So it makes it easy to swap them there with very little slippage. So two terms.
Oh yeah. Okay.
Liquidity.
You got to explain these two.
Liquidity and slippage. Well, liquidity means that there's lots of buyers and lots of sellers meeting at the right time, basically. So when a market is liquid, that means you can sell a large quantity of something for a fixed price that's transparent, that's known to you at the time of transaction. If the market is illiquid, then there's a price that you always only see. So when you look at a stock market ticker or even the price of Bitcoin, it's always the last transaction, right? That's the price that you're currently looking at. So that does not necessarily mean that your transaction, even if it's just the next second after that last one, that it goes through for the exact same price. It does not mean that. It might be higher, it might be lower, right? And so if liquidity is poor, if there's no liquidity, and then there's a price, okay, it says $20,000, and then now you try to sell, and you get, instead of 20,000, you get $15,000. Well, then there was really bad liquidity. That means there was no bids, right? Nobody was bidding to buy, and maybe there was a few people bidding to buy, but they only wanted $5 worth of Bitcoin, right? But you were selling $50,000 worth of Bitcoin. Well, then that $5 bid is no good for you, right? Because you need a bunch of these people. You need thousands of these to make up, to fill your offer, so to say. And so this other word that I said, slippage, is kind of expressed in that as well. So if you say, hey, I'm selling one Bitcoin, the last transaction price that's known to you is 20,000, and then you say push go, sell now, and then it ends up selling for, say, 19,857. Well, then that difference, I should have picked an easier number. Say it sold for $19,800. So then the $200 difference, you could say, was slippage, right? So it slipped lower in price than you were expecting. Yeah, correct me if any of that was wrong.
Yeah, and then the deeper the liquidity, the lower the chance of that happening, I guess, is because you'll find more bids and ask to match your amount of trade, or not bids and ask in this case, but the algorithm in the case of Uniswap, the automated market maker will match your trade, depending on the size that you have, right?
Yeah, so instead of this these order books that you find in exchanges, I guess the automated market makers, they've kind of solved this problem through liquidity pools. So they basically get people to enter token as collateral, and this always has to be a matched token pair. So for example, it has to be Ethereum and USDT, or maybe DAI, let's say. Yeah, and then or USDC. And so then you enter so you want to put 10,000 into this liquidity pool. That means you put $5,000 worth of Ethereum and $5,000 worth of USDC, right? And so now you're entering that as a matched pair, and the automated market maker will then use this that you've kind of borrowed to them to help route transactions with high liquidity through. And usually as a result, you are rewarded for providing this liquidity. You're rewarded with part of the transaction fees that these that Uniswap or some other places might generate from people exchanging tokens. So this is already getting pretty complex. Like now we're deep in DeFi territory.
Yeah, we can link something down below that explains automated market makers. There's some good videos out there. Yeah. Things like that. But I guess maybe we can then now have a look at demand of tokens. I mean, we went into it a little bit already, but like Uniswap and its deep liquidity is something like to complete, like the token aside, right? But just seeing Uniswap as a product. So if you are a fund or somebody with a lot of money and you trade your money back and forth, like if you only have like $10 worth of ETH and you want to trade that for $10 of DAI, you don't have to worry that much about liquidity, because like $1,000 pool will be pretty deep for the trade you want to do. But if you have larger amounts of money that you want to trade, the higher the risk that you're going to move the needle in terms of price, and the slippage thing will kind of could possibly ruin your trade. So you want deep liquidity if you have a lot of money that you're trading around. And so Uniswap, in providing that deep liquidity, has kind of this competitive advantage, right? Because everybody knows the name, everybody's like, people who are in crypto, they've heard of it. And if they've ever traded some Ethereum tokens, it's highly likely that they've done it on Uniswap. And bigger trades will also get executed there because there's all this liquidity there on their platform. And so that's kind of their, I guess, competitive advantage. And having all that liquidity there will attract a lot of trades. So lots of people go there and trade, and thus will pay fees. And these fees will accumulate in their treasury, right? So, and that then kind of is revenue, or to some degree also profit, because Uniswap doesn't have a lot of expenses. That would be to some degree profits for them, right? And that then, if you think of like, why would you buy Amazon? Because it's a great corporation that churns out a lot of profit, not to myself, but like they reinvest it. So in this case, this might also create demand for the Uni token. So they have a token that allows you to help to govern their protocol. And you can buy that token, and having a great product behind it, which Uniswap seems to be, because it is the largest revenue generator, or one of the largest out there. You might want to buy that token because it gives you access to that. So I think that's a pretty cool thing.
Not investment advice. Do your own research.
Of course, yeah. I mean, that's don't we have like this thing at the end of the podcast that says that?
Yes, we do.
Yeah.
But
it's exactly that.
Just goes to show that some tokens can be engineered to try to capture value, right? So Uniswap clearly has created something that generates value for people because they want to exchange tokens. Great, and you want to do that with minimal downside, and they have done a pretty good job with that. So what they have is valuable. So if you can connect this valuable engine that churns out revenue to a token, that may be a good investment. That makes logical sense, right? Without making any sort of recommendation specifically to Uniswap. This is just an example. But so these this liquidity thing is fickle, right? So during DeFi summer, I've read many times that new protocols that launched, they would then create a liquidity pool on Uniswap or some other place, because they try to get people into their token. They try to make it easy for people to swap in and buy their tokens, essentially. And often, but how did this work, right? So because they try to incentivize people to get their token, to even enter their tokens as collateral into a liquidity pool, because that's the only way that seamless swapping can even happen in the first place, right? So like behind the Uniswap, there's people who are kind of going deeper and they're providing liquidity to the exchange. But then that has problems because investors will only give their collateral to liquidity pools that pay them really high rewards, right? So then it becomes like this beauty pageant of like, oh, this place is paying 300%, this one's paying 200, maybe, oh, no, it's only 30. Well, as soon as it's only 30,
Yeah.
I'm definitely going to pull all my money out and go take it somewhere else, right? And I think, so this is what all the stuff I'm saying is trying to be the segue to this concept of protocol-owned liquidity, which I think is supposed to be the solution for that. But so how does protocol-owned liquidity work?
Yeah, this is like almost like another whole thing. It's quite complicated. I've written about it in, like, I wrote a piece on DAO, and I think there I've covered it to some degree. So what it is that they circumvent this mechanism, right? In where liquidity hops from protocol to protocol following these token incentives. So they would give out tokens and say, hey, you get our native protocol tokens if you provide liquidity to us. But then they would let the users own that liquidity. So when they stopped the tap, like they ran out of their own native tokens to distribute to people, the people with that liquidity, they would go off to a different protocol and do it there, the same thing. And so what they said, why don't we design a mechanism where we keep that, right? So in their case, then they offer their own token in reward for a payment in a token that they want to own liquidity in, right? So in the case of Olympus DAO, they do that. They've pioneered that. They collect DAI. So someone who provides them DAI gets discounted OHM tokens, and that way they can collect their own tokens. And then they also have this mechanism on the other side where they incentivize OHM holders to stake OHM because they have a very high inflation. So if you don't stake, your share is gonna get diluted and inflated away, right? Because there's so many new tokens introduced to the market. If you don't stake, basically you lose money. So they incentivize with that. They incentivize people to stake their tokens. So then they have DAI and they have staked OHM, both of them, right? They have that in their treasury. They have access to that, and then they can just place that on exchanges like Uniswap, and provide their own liquidity for these trades, right? So they can open up a pool with DAI and OHM or Klima and USDC or whatever. They can provide that to these exchanges, and then if people trade their tokens, they will get rewarded for it, right? So they will own their own treasury and put it out on these exchanges like Uniswap or SushiSwap. And if someone trades, they will collect the fee. And then actually the fee collection for for people trading their tokens will actually be, part or one of the revenue streams for them. And that way they can actually create deep liquidity between their token and another token, and also profit from it. So own it, right? So that's an interesting, like another interesting mechanism, I guess, in what you could do with these smart contracts in designing it, and therefore perhaps creating demand for the token, because people would look at the mechanism, would think like, oh, this is quite interesting. If this works out and if this happens, then their token will go up because of that. So that's, I guess, another one of these sort of things that can be implemented.
Yeah, I mean, it's a really smart idea, right? So rather than incentivizing token holders to go and provide liquidity, you're saying, no, you guys just stake, and actually the protocol itself will provide the liquidity, and the benefits in a way, like indirectly, get redistributed to token holders anyway, right? Because it just makes, because it's just revenue for the protocol. So and it solves that problem with the kind of disappearing liquidity as as investors get bored or they don't feel incentivized anymore, and the next guy comes and pays them 10% more for the liquidity, so then they will wander off. So that's definitely a smart mechanism.
So then, like, yeah, so like I guess like in the demand space, what else is there? Like that'd be kind of the things to look out for, right? What mechanisms are there that impact supply and demand? Like something that has been programmed into smart contracts that you could observe when you look at a token or a project. Then maybe also like the utility. Like there's interesting projects like Chainlink, which is an Oracle provider. So that means they provide outside information into the blockchain, and you can't just do that. That needs specific mechanisms. I'm not going to go into the details there, but let's say they provide weather information for like, if it rains in Sydney, they were going to pay Lovis out some ETH. That a pretty good bet this year because it's raining a lot. So let's say someone has programmed that, you would need to trust that source in telling you that it's raining, right? So if Lovis would manipulate that source, he could manipulate that, he'll get all the pay. And so I guess, yeah, that's something this Oracle provider does. And in order to use their Oracle, you need their link token. So you need to use that link token to feed that. So their link token has a real utility, right? So it's like you had, like Amazon would issue a token that you could use to access certain functionalities on their AWS. So you could execute 1 hour of 10 gigabyte compute for 3 tokens. And so that's kind of what they're doing here. So really the token is this access to their API.
Yeah. I mean, Amazon just uses the US dollar token, right? Mostly. Same idea.
It's backed by guns, yeah.
But yeah, utility staking. I think you've touched on staking before, but maybe we can add some more color to it. So the base idea, original idea of staking was proof of stake is an alternative to secure a network, right? So each of these blockchain networks needs to be secured. There needs to be nodes, which are essentially independent computers, independent entities that verify transactions. And there's a mechanism, mathematical mechanism, that they all have to agree on the truth, so to say, on the status quo. And if one of them disagrees, that's okay, because all the other ones agree, so they just discard that one. So if one node's trying to be fraudulent, let's say, actually, Lovis's wallet has 1 million Bitcoin in it, and all the other nodes are like, no, it doesn't, then it's discarded, and that's how they secure the network against fraud. And Bitcoin famously does this with proof of work, which means you have to invest lots of electrical energy solving these math problems, and through that creates this consensus mechanism. Proof of stake is different, where you are locking capital essentially. So you're putting your capital or your tokens at risk, and you're saying, hey, I'm operating a node. I'm risking my capital. So for example, I have 32 ETH, right, which is coincidentally the required amount for operating a full node on ETH soon. And there's a simple program that I can run on my laptop, so no heavy industrial mining equipment, Bitcoin or proof of work mining equipment required anymore. I can just run it on a lightweight computer. But mechanism is largely similar in the sense that my computer now is a node that verifies transactions. And if I cheat, if I say, oh, but again, Lovis's wallet actually has a gazillion Ethereum in it, and then the rest of the network says, no, it doesn't, and you try to cheat, so then they will actually take away from that 32 ETH that was staked, right? That was put at risk. This is,
I think it's mainly like for uptime, right? If you don't validate transactions on time, things like that.
Right, and of course, so Ethereum is now doing it, and so they're becoming the most, or they're transitioning towards proof of stake. So they're becoming the most famous example, but by no means I don't think Vitalik has not invented proof of stake, right? There was other chains that have been doing that since
I think so too. Yeah.
but this idea of proof of stake is what introduced staking rewards, as far as I understand it. So that means people that were operating a node, they were providing value to the network, right? They were securing the network. And so in return for their effort or for the risk they were taking with their capital, they got paid, right? They got a little bit of a reward, very similar to the miners in the Bitcoin network with proof of work, right? So I don't know, Quantum was one that was already around 2017. I actually ran a full node for a little while, and you got to make, I think, like 4 or 5% per year in staking rewards for operating that node. And then later, that thing kind of morphed into this thing where now it's like, oh, you got a token, or you just got to stake it, right? Like it doesn't really, you're not really doing anything other than just locking it for a time period. Really, all you're saying as the token holder is, I promise not to sell it for X amount of time. And then protocols will often give you token in return, which is, you're not, it's very arguable if this really provides value to the network. But it's, of course, it's an attractive promotional feature, I guess, you can have.
Yeah. And I guess like all of that will give you, even though it doesn't allow you to predict demand precisely or like accurately, it does allow you to get a feeling for where demand for the token could come from, right? So if it gives you API access, yeah, that's probably drives demand to a certain degree. If it gives you access to protocol revenue like staking does, then that's also something, right? That might get you to buy the token and hold it. And another thing could be voting. There's lots of other things, right? So in DAOs or community type settings, and I guess that's something that we haven't really gone into, is this idea of that you could have a community that is governed by a token. So it's essentially, it's this like, so I read this great article yesterday by this guy, and it he explained it with this like train club. He said like, oh, there's these people, they're all train enthusiasts, right? So I like trains, and they, like, before tokens, they just met and they talked about it. Maybe they created a nice website, they hosted events, did that. They maybe even collected some money. But like with such a token, you could then introduce shares to this, right? So that certain people could have shares of this treasury and they could decide how to use that treasury. And that's something that's, I think, is really, really interesting. That's emerging, is like how to use tokens to govern and create ownership in communities. And yeah, if you've listened to the past 17 episodes, I think we've talked about a lot of that.
Yeah.
And there's plenty of episodes with that. So yeah.
Yeah, so I mean, so this goes into social tokens and DAOs and
yeah.
Governance structures. And that's, so governance in itself is a huge, I mean, yeah, like Phil just said, we've talked about this many times. It's an emerging field. How do you use tokens to, incentivize or steer, control, not control, but I guess guide outcomes, right? Positive outcomes. If that's, we don't know what it is, but we want it to be positive. And how can you use a token to bring that about? Super, super interesting. I think there's a lot is gonna happen there in the next couple of decades. And yeah, anybody that pretends to know the answers at this time is not truthful, because it's all it's like it's developing in front of our eyes, and it's fascinating, and it's I highly recommend to get involved yourself. But it's a deep thing.
So I think we've got like one thing left.
Yeah.
Or do you see anything else that we're missing? No, we got some deeper concepts to explore. Maybe we'll save them for another one. But
well, we have the last thing, right? Like how do we do this?
Yeah.
How do we tackle these?
Yeah, how do we do this? Yeah, that could be something. So I guess being the tokenomics DAO, being part of the tokenomics DAO, we spend a lot of time thinking about this and like evaluating different protocols, helping others, designing them. So I think we've started some attempts or various attempts, created like lots of content in this field, and yeah, we've created this evaluation framework, which at this stage is just a survey kind of tool that allows you to, or takes you through a lot of questions, and a lot of these questions cover a lot of that stuff that we've discussed today. It'll talk about like what is the value the business actually creates, and how is the token connected to that. What's the supply of the token that they're going to introduce, all of that. And we're going through that in this survey-like format, and letting the person doing the survey answer these questions and rate them. And then based on that rating, we just sum that up and do an average to then create a score for a certain project. So I've done it for Ethereum. I've posted it on Twitter with my answers to these questions. You can check it out. We can link it here. So that's one of the things that we do. I guess we've also been working on a design framework on because evaluation framework would be more something for investors, for people, retail or professional or institutional, that would look at investing stuff into tokens. But then we also have been working on something that will help people design their own tokenomics with the knowledge that we've gained from various projects we've done, and our own token that we've been thinking about. So we've been doing that. So that would include, like a step-by-step guide on how to actually design your token, what you have to think about, what mechanisms do you want to put in place, what utility you want to run on, like what are the problems you're trying to solve with that.
Yep.
So yeah, we do have that. We're working on it. It's not yet finished.
No, it's not finished. It's a work in progress. And first question is, do you even need a token? Because you should
90% stop there. So
yeah, and that's good, right? Because many applications really don't need one. But it's not so much whether actually. So the answer is of course deeper. It's not so much whether or not you need it. It's what's your value creation, and then how can we connect a token to that in a smart way? Because this goes back again to the demand drivers, right? If you don't have a demand driver in the project that you're doing, then you can still have a token, but the nominal value development of that token just might be disappointing. Let's just say that.
Yeah. If you have a lot of revenue, that might just be enough. You don't need anything else. But if you don't even have any revenue, and you don't have any demand drivers, then yeah, you might not be that lucky.
Yeah. Then another thing that Tokenomics DAO does, and of course this is where the whole movement, I want to say, started, was Flo created this Tokenomics 101 article format, and has written many of them himself. And so now we've actually made that part of how people join the DAO, is we're asking new members to come in and write one of these Tokenomics 101 articles on a protocol. And I guess our goal is to document all the protocols out there, which is a big task.
Yeah.
Never be done. But we're, basically the way it works is, if you want to be part of Tokenomics DAO, join our Discord, come to one of the orientation sessions. They usually happen weekly, at least 2 or 3 times a month minimum, and then explain this in more detail. But the long and the short of it at the moment, come and write a Tokenomics 101 article. We have a template for it, and that will, our goal is to get that to a quality where we can publish it with your name on it, with the DAO's name on it. And that'll basically be your entry into becoming a contributor in this DAO as well. And then what do contributors do in this DAO? Well, they solve problems, right? So we have lots of challenges to overcome. We're still a young community. We're growing quickly. So with that, we always need people to come in and own certain topics, right, that need improvement. There's also opportunities to come in and consult for others, for clients, right? For outside clients outside of the DAO. And we have some of these. We still always want more of those. And we are growing our consulting arm. However, definitely don't just join the DAO to become a consultant. There's a lot more to do than that. And the whole thing kind of lives off of tokenomics related content, just very much like this podcast episode you're listening to right now. So even if you do a consulting project, you'll still be asked to produce content about it, to share your learnings with the community and the rest of the world.
Yeah, and keep you learning as well. I think that's also important, right?
Absolutely.
Like every one of these articles that I write, I just learn so much by figuring out what they've done, why they do it, and yeah, making up your mind about if that's a good or a bad thing. Anyway, yeah, I think that's pretty cool. Cool.
Yeah, for sure. It's a never-ending learning journey, and if you take a week off and then you come back, you're like, whoa, the whole thing changed. It's so, because it moves so fast.
Everything changed.
So
yeah.
developments all the time.
True.
Very good.
Yeah.
Only one thing
All
I
right.
wanted to. So we were also in the DAO. We're also working on a basics of tokenomics series. So the goal is to create like 30 tweets or tweet format pieces of content. We're like almost halfway there, but we're slowly starting to trickle those out on Twitter. So if you want more basics of tokenomics content, keep an eye out on Twitter. If you want to jump in and help, please do so. Join Discord, come to us. We have all this stuff ready to go, and we need people to also want to grab this and make videos to post on social media and all these other things. So please get involved. Any knowledge level, like I said, it starts with basics and it goes all the way to advanced. But yeah, we're happy for anybody who wants to come and contribute.
Cool. Awesome.
Yep. Cool. Thank you, Flo. It was good. It was interesting. And see you soon.
Till next time. This podcast was not financial or tax advice. This channel is strictly educational and is not investment advice or a solicitation to buy or sell any assets or to make any financial decisions. This video is not tax advice. Talk to your accountant, do your own research. None of this is legal advice. This podcast is strictly educational. Talk to your lawyer.